Hello students. So as you know that we are discussing about our second chapter of macroeconomics, some basic concept of macroeconomics. Okay. So we will proceed to this to our video concept of depreciation. Okay. Students, depreciation means consumption of fixed asset. Now what does it mean? When a fixed asset is purchased by a producer, then year after year its nominal value will get reduced due to its use. For example, if a producer purchases a machine for 1 lakh and after 2 years of its use, its present value will be less than 1 lakh due to its use. Secondly, now after 2 years, market may got new level of technology and new machines. So in this condition the value may further got reduced, so this decrement in the value on of fixed asset terms as depreciation. And depreciation can because of normal wear and tear, accidental damages, expected obsolescence, and new uh, uh, and introduction of new level of technology. Our fixed value of our fixed asset got reduced, so the reduction in this value of fixed asset is termed as depreciation. Okay. Again, there is a term which is used in depreciation, that is depreciation reserve fund. What is this depreciation reserve fund? As you can see the explanation of the chapter on your screens, let me explain. A term is used, that is depreciation reserve fund. It means every producer in economy makes a depreciation reserve fund, which means to allocate some profit in a separate fund which is used in replacement of that asset. Year after year, some profit is channelized in a separate fund which reduces some burden of producer, so that after some year he will be able to replace that depreciated asset with a new asset via using this fund. Okay. Here an important concept is also arose, that is what is the difference between expected and unexpected obsolescence. Means what is the difference between expected losses and unexpected losses. Okay, you can also see on screen. I will also explain expected obsolescence. It means it is the expected fall in the value of fixed asset which is due to normal use, which is due to normal wear and tear and daily running of that machine. Okay, and it is managed by creating a separate fund which is a depreciation reserve fund. And again, there is also concept of unexpected obsolescence. Okay, for sake of understanding, let me turn this slide. Yes, from this first dialog box you can easily understand the difference between expected obsolescence and unexpected obsolescence. Unexpected obsolescence means it is unexpected loss of fixed asset which is not due to normal use of that asset, it is due to the natural calamity, theft, fire. These all are the unexpected events, and there is also not a separate fund to cover these losses. So these are the unexpected losses. Okay, and there is also consumption of fixed capital and capital loss. But all these terms na, like expected obsolescence and unexpected obsolescence, consumption of fixed capital and capital loss are are very simple terms. You only have to understand the basic difference between these terms. Okay, so first we will discuss about consumption of fixed capital. Again, these are the losses that is due to the normal use and it reduces the value due to the use of fixed asset and also got managed by depreciation fund. And what are the capital losses? These losses are those losses whose value is fall when fixed asset are not in use. Like if a machine of a producer got destroyed by fire, got destroyed by earthquake, theft by thieves. So all so And these types of losses are also not supported by depreciation reserve fund. So this is the difference between consumption of fixed asset and capital losses. Okay, so here a fourth point of this chapter is stock and flow. What is the meaning of flow and what is the meaning of stock? It means those variable. First we will discuss about stock. What is the stock concept? It means those variable which can be measured at a point of time. For example, uh, you have 20,000 in your bank account on 1st January 2020. So it is the example of stock. It is termed as a stock concept. Okay. And again, what is the meaning of flow? As you can see on your screens, it means those economic variable which are measured over a period of time. Like you got 1 lakh as your monthly income, so that is an example of flow because you express it over a period of time. Say for 1 month, each and every person in this economy and of any country got his income of 1 month. So all the income and there are also some examples of flow like expenditure of money, capital formation are all the examples of flow concept. Now you can easily understand the concept of stock and flow concept as you can read it by yourself. Examples are there on your screens. Okay, look at the some examples. Firstly, look at the stock concept: wealth, labor force, capital, a bank deposit. All these 9 examples are of stock concept. And income, expenditure of money, capital formation, all these 9 examples are of flow concept. A very very easy concept, both stock and flow. Okay, so now let us shift to the another important point. Fifth important point is fourth sec four sector of the economy. Okay, from macro point of view, economy is divided into 4 sectors. Every economy of the earth is divided in 4 sector. There is household sector, producer sector, government sector, and external sector. First of all, we will discuss about household sector. What is the household sector? Yeah. This sector include consumers of goods and services. They are also the owner of factor of production. Okay, all the consumers of goods and services like you and me, we are the consumers of goods and services, and we are the also owner of factor of production because we are the person who goes to the factory and work there. We provide raw material to the production sector. So all we are included firstly in household sector. Okay, secondly there is producer sector. It include all producing units in the economy. For example, for the production of goods and services. Okay. Thirdly, there is government sector. Government sector makes laws and regulations in the economy and also support law and order in the economy. Okay. And fourthly, there is external sector. It include foreign sector to whom export and import of goods and services is being done. Okay. So now these are the 4 sectors work. We will see in our next video, and after that our second chapter is also got completed. But there is a sixth important point which is intersectoral flow. It means each sector is dependent on other sector, like household sector depend on producer sector for consumption. Now producer sector produces goods and services and sell to the household sector. Producer sector depend on household sector for supply of labor, raw material which is used in production process. And also government government sector also depend on producer and household sectors for its tax and non-tax receipts. We know that household sectors pay tax to the government, and producer sector also pays taxes to the government. And producer sector and household sectors depend upon government for making laws and order and defense. So in this way, all the sectors of an economy is dependent upon each other for their smooth workings. Now there is the important concept, that is real flow. What is real flow and money flow? In all the economy, there are majorly there are two concepts. One is real flow, and secondly there is money flow. So first we will discuss about real flow. It is the flow of goods and services and raw material and labor from one sector to another sector. For example, household give raw material and labor to producer sector, and producer sector gives finished goods to household sector. This is the real flow. And again, what is money flow? It refers to the flow of money across different sector of the economy. The payment of raw material and wages for the labor is given by the producer sector to the household sector, and the money in lieu of goods and services which is spent by the household for the purchases and earned by producer sector for the sale of goods and services. As you can on your screen, this household sector is paying for purchase of goods and services, and producer sector is paying the payment of factor services to the household sector. In this way, the real flow and money flow works in economy. Okay. Thus I will read. Money flow from household to the producer is the reciprocal of real flow of goods from the producer to the household sector. Likewise, money flow from producer to the household is the reciprocal of the real flow of factor services from the household to the producer sector. Okay, so in this video we have completed our 6 major important points of this chapter, and there is only I think 1 or 2 points which are remaining, which we will complete it in our next video. Okay, so for today it is over. Thanks and have a nice day.